Today, we're going to have a heart-to-heart discussion about China equities. You know, if you have followed this channel, you do know that I've been buying the China equities. So if they have fallen, naturally, my Chinese portfolio is in red. I'd like to share with you some of my deepest thoughts, as well as what you can take away from this discussion. To start things with, let's see the context of the whole thing. If we see Alibaba is the shining example of Chinese equities, correct? It's fallen from 300 all the way now to $90. If you ask someone 1 year ago, what's the worst case situation for Alibaba? He or she will say naturally, probably 200, 180, that's the worst. But little did we know that Alibaba is now $90 and still falling. I've actually set up two Chinese portfolios. The first one is actually $1,000 for 50 weeks. The second one is a further $2,000 for 10 weeks. Later, I results for you. I'll be comparing it against a JPMorgan China fund that I bought with a lump sum. So there are learning points. And in any case, if you haven't seen some of my previous tutorials, I'll leave links above and towards the end of this. So let's start with the P&L for the Chinese equity first, using the lump sum. As of today, which is 12th of March, it is right now losing more than 35%. Again, for unit trust, the pricing is always 1-2 days late because they do the NAV at the end of the day and they report only a couple of days later. My guess is probably like minus 38 or minus 40%. So no joke about it. But again, I didn't buy Alibaba or Chinese tech at its peak. I entered way later only. But the key part I've been trying to suggest through this channel is when it comes to the bear market, you need to approach it very differently. And later I'll show you the real numbers as well as some psychological things so that you kind of know and be a bit more wiser the next time you face bear markets, because we do see quite a lot of influencers and YouTubers now saying that possibly S&P might face a bear market. I've been echoing that for a bit. This war is more serious than past wars, but neither can we be sure that it's the bottom and stuff. It's just you have to be a bit more patient, expectations wise. The only thing you can take away is expectations. You shouldn't expect a quick rebound. Neither should you go and hide, so do keep a balance. Let's look at the second portfolio first. I think it's a bit more interesting. 2,000 for 10 weeks and I actually started it in January. Total investment amount is 18,000. Now value is 14,900. So lost 3,000 plus. Time weighted return is minus 21%. The problem with this is there's only one more bullet left. So I fired 10 weeks. 18,000 means I fired 9 weeks already. So only one last bullet left. And the Chinese bear market seems to still be strangling all of us investors. Why did I actually increase this amount? Maybe I can give you some of my own thinking process also. You see, right, this was a phase where I thought it was pretty extreme already in terms of sentiment. I carve up the later portion so you kind of know, using Alibaba again as a graph. You realize that in the start of January, it kind of have a fake out down and it kind of stabilized. I've seen patterns before and I do think that looked very much resembling like a bottoming period at least. But what we can see now, this period is way above my wildest expectations. It dived even further by another 15%. So as always, bear markets, don't underestimate it. And the saying goes, the markets can stay irrational longer than you stay solvent. I repeat again, the markets can stay irrational longer than you can stay solvent, which means you can't buy and hope you last a bear market easily. It's not that easy. I've seen from my experience 2008 bear market globally, global equities during the global financial crisis. That bear market really took the hearts out of many investors. I was really doing advisory work then already. Many threw in the towel. That's the reality of things. And Chinese equities now are teaching us and giving us a very good lesson. Using that experience, I realized the need to avoid buying the dips, something I've suggested before on this channel. So hopefully you've also took my idea. If you're keen, you agree that it's risk reward good, space it out, go slow. And indeed now the 2,000 for 10 weeks portfolio is running out of bullets. Imagine this, goodness, one last bullet left. GG already. I think this portfolio is going to take a long while to recover actually. The one which I'm a bit more optimistic is this last point of comparison, 1,000 for 50 weeks. I've invested 13,000 already, which means 13 weeks of firing. Pa, pa, pa. And thank goodness, I still have another 37 more bullets to fire off. Although a weighted return is minus 26%, I do think this has much better chance of catching the final bottom. Bottom still got another bottom. It really takes the heart out. And again, if you are also in sorrows, smash a like, leave your complaints in the comment sections. We can all debate a bit further. My worry is this bear would actually extend to US tech NASDAQ, which is why I've suggested possibly falling knife. A lot of things I mentioned on private members channel. And if you see this, total market value now is only 10,272, which means I've lost $2,700. I have something interesting to show you in terms of perception as to how much you can lose. Let's use Alibaba as an example. If you're interested in it when it was $300 and then you didn't buy, you saw it decline until $200. Finally, rejoice. Value proposition. Great investment opportunity. You bought at $200. Thinking that that could be the bottom, you lump sum went in. And then, lo and behold, now it's $100. So you'll be thinking, 300 to 200, as we can see over here, and then 200 to 100. So the person that bought at 300 has lost 67%. But what is your loss? If the person put 30,000, the person is only left with 10,000, lost 67%. What is your loss? Is your loss only half of that person's loss, which is half of 20,000? Which means you only lose 10,000 since you invested at 200 instead of 300? The answer is no. If you see the graph actually, from 200 to 100, your total loss is 50%, which means you've actually lost 15,000 if you put 30,000. Now, and the worst part is 15,000 in just 8 months, whereas the other person investing right at the very peak lost for 17 months and only lost 20,000. You 15,000, the other person 20,000 loss. Actually, not much difference there. You realize? Because when it comes down to $200 per share, your 30,000 now buys 150 units, not 100 units. And when percentages drop, you realize that your losses grow very big also, even though you entered at a supposed much lower point. So again, the key rounding point is in bear markets, go with a long dollar cost averaging. I can't emphasize that enough. But today's video, I have something extra for you since you stayed to here with me. I'll share with you what I'll be approaching this whole Chinese tech market. You know, in poker, I don't know whether you play poker or not. Sometimes you have a good hand, but you're not very sure whether you have the winning hand or not. You probably guess you're in the lead. But instead of betting, you check behind. And the reason of it is something called pot control, which is if you're not too sure whether you are definitely in the winning position or not. You know that the odds favor you, but things could always turn out wrong. That's why you do a pot control. You don't bet even though you're still in the lead. That's the approach I'm taking. If I exhaust this 10 weeks for $2,000, 20,000 in extra, I won't be putting more in already. I'll let the remaining pot, which is this 1,000 for 50 weeks, continue to pick up, and total investments will be $70,000. Where I'll be looking to deploy more capital, I've shared on the channel many times. Commodities as well as possibly Singapore banks, Singapore equities. I see value there. I won't be doubling down too much into China unless we see a resolving bear market. Things start to look a bit shiny. That's where we see earnings expansion, price earnings ratio expansion also. That's the thing I teach on the channel. That is a much better situation to keep doubling down. This bear market is not easy to fight. Hopefully you still have bullets. And if you have taken a suggestion so far, you should sleep sound. And with that, let me introduce you to a previous video I've done. This is regarding Facebook. Something also very popular. And on the private members channel, which I'll leave links below, you realize that I've actually called for Facebook to possibly even crack $200 a share. He's already done that against all expectations when that day it crashed. When you bought 6 months ago, you have lost 50%. But the problem is, even if you have escaped the shock of that day, you bought when it crashed, you have lost more than 20% already, and in 1 month. So again, don't underestimate falling knives, don't underestimate bear markets, invest safe, and as always, leave any questions you have. I'll try to help you as best as I can. With that, I'll sign off. I'll see you next video. Take care and goodbye.